Major Asian markets declined on Wednesday as global trade concerns weighed on investor sentiment. The Nikkei 225 slipped 0.53% to close at 21,638.16, while the Shanghai Composite was lower by 0.94% to close at 3,015. South Korea's Kospi also declined 1.23% to close at 2,096.02. Over in Australia, the S&P ASX 200 bucked the overall trend in the region as it ended its trading day 0.43% higher at 6,685.50. Hong Kong's Hang Seng Index slipped more than 0.2% as of its final hour of trading. On the data front, the K-Shen Market Services Purchasing Managers Index fell to 52 points in June, the lowest since February, and down from May's 52.7. The sub-index for new business rose to 53.4 in June from 52.9. New export orders placed with Chinese services firms contracted for the first time in 9 months in June, with companies citing subdued global demand and tariffs. European stock prices rallied on Wednesday as the EU finally reached an agreement on a number of key appointments, including IMF chief Christine Lagarde as the first female head of the European Central Bank. The Pan-European Stock 600 closed provisionally by 0.8%, with the majority of sectors on all major bourses in positive territory. Frankfurt's blue chip DAX 30, London's FTSE, and the CAC 40 in Paris all rose by well over 0.5% at the close, with Paris even setting a new high for 2019. In terms of data, PMI surveys published Wednesday collectively indicated that the UK economy has slipped into contraction for the first time since June 2016 and has suffered the second sharpest decline in output since the peak of the global financial crisis in April 2009, against the backdrop of Brexit and concerns about the world economy. On Wall Street, all three major stock indices surging to records after a plethora of mediocre U.S. economic data appeared to boost the odds of a Federal Reserve interest rate cut. In a session shortened ahead of the Independence Day holiday, the Dow, S&P 500, and Nasdaq all jumped to records a day before celebrations are to be marked with fireworks around the United States. U.S. jobless claims fell modestly, while the crucial services sector expanded but grew at the weakest pace in nearly 2 years as business activity, hiring, and new orders all declined. A key report will come Friday when the Labor Department releases estimates for June job growth. Analysts expect the U.S. added 160,000 jobs and that unemployment held steady at 3.6%. Oil prices recovered somewhat Wednesday after data showed another drop in U.S. crude stockpiles, but the rebound made only a dent in the 4% slump Tuesday triggered by weak demand growth worries. The data showed U.S. crude inventories fell by 1.1 million barrels in the latest week, a much smaller decline than the 3 million barrel decrease analysts had expected. The U.S. imports rebounded while exports fell sharply from a record 3.8 million barrels per day a week earlier. As a reminder, the Organization of the Petroleum Exporting Countries and other producers, such as Russia, a group known as OPEC+, agreed to extend oil supply cuts until March 2020. Still, signs of a global economic slowdown hitting oil demand worried investors after global manufacturing indicators disappointed and the United States threatened Europe with more tariffs. Gold prices continued to hold above $1,400 an ounce, while sentiment in the United States service sector dropped lower last month, according to the latest data from the Institute for Supply Management. Wednesday, the ISM said its manufacturing index showed a reading of 54.1% for June, down from May's reading of 56.9%. The data was weaker than expected, as consensus forecasts were calling for a reading of 56.1%. This is the lowest reading since August 2017, and the data has missed expectations 3 out of the 4 last months. The latest employment data provides further support for the Federal Reserve rate cut by the end of the month. As a result, gold demand remains robust despite some bearish correction in the daily charts. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.